Hey everyone, and welcome back to another video for today. So over the past week, the couch investing portfolio was actually up 1.31%, whereas the S&P 500 was down 2.42%. Year to date, the portfolio is still doing very well, up 64.36%, whereas the S&P 500 is up 11.42%. And since the start of the portfolio, it's up 162.4%, whereas the S&P 500 is up 31.46%. And so in today's video, we're going to talk about the upcoming earnings week because, as you can see, some big companies are about to report their quarterly figures. We'll talk about what happened on Friday, some market data, and of course the call that you don't want to get. And then, as promised, some little snippets from a great book, Just Keep Buying. And then, of course, if you missed Friday's videos, I'll just ask you the same questions again. Now, to start off with what happened Friday, the Kobesi letter basically posted this. We've had the S&P 500 that is trading here at a record high. Then we've had the first big, huge candle after President Trump posts statement on massive China tariff increase and cancels meeting with Xi. Then we have dip buyers that attempt to step in. And afterwards, we've had basically the crash again. So the S&P 500 erases $1.2 trillion in 40 minutes. In the crypto market, we've also had the, number one liquidity event of all times. And of course, when you put everything that's happened with the market together, the VIX, the volatility index, has of course gone up, and we're now at the highest point we've been since May. And of course, as you know, every time it did spike in the past, there were quite a lot of opportunities and the dip was bought quite quickly. Is the same going to happen right now, or is the VIX going to go even higher and it's going to take an extra couple of days? Well, as you will see, it doesn't really matter much. By the way, again, this fear and greed index, I still have no idea how this thing is already so close to extreme fear after just one day. But okay. Hey, if this is the way this index goes, then I guess even when we are in extreme greed, it doesn't really mean much. Now, for the upcoming week, we have a couple of big companies, of course, reporting. We have a lot of banks, financials, right? On Tuesday, you've got BlackRock, JP Morgan Chase, Goldman Sachs, Citi, Wells & Fargo, Johnson & Johnson's, Domino's Pizzas. Then on Wednesday, we've got ASML. That's going to be quite interesting now. Bank of America, Morgan Stanley, Dollar Tree. After the market closes, you've got United. And then on Thursday, another huge one, especially in this semiconductor, this AI space. TSMC, Infosys reports as well, Charles Schwab reports. And then after the close on Thursday, we've got Interactive Brokers. I mean, that would be quite nice to get more information about what's going on their platform. Did a lot of their customers get the margin call or not? And then on Friday, we've got here American Express, we've got Alibank, State Street, Truist. So a pretty big week in the financial sector. And then we've got two huge names in the semiconductor sector. Now, touching on the portfolio, of course, on Friday, it wasn't a good day. The portfolio was down, let's call it 5%, right? So it was not a good day on Friday. Now, what did I do throughout the week? As you know, I did purchase a couple of shares of Rubrik. I did increase that position by 16% at the start of the week and Shift4 by 20%. I did also increase Oscar Health by around 8%. Of course, if you look at Oscar Health, it did go a little bit lower. With Rubrik and Shift4, didn't really matter that much. Overall, the performance throughout the week was pretty good because, Nebius did perform extremely well. Rocket Lab performed extremely well up until that Friday, right? On Friday, everything went down. But still, we are here. I mean, SoFi is still number one, Nebius number two, Rocket Lab number three, Google is number four. So Rocket Lab being number three was already one of the, let's say, signs of things being extremely hot. Right, because Rocket Lab is a great company, great future, but in my portfolio, it already surpassed Google, which means that it was trading at an extreme multiple. Now, I did not take profits from Rocket Lab just yet. I did take already in June, but since June, I did buy almost all of the shares that I sold. I think I was missing 25 shares or so. We'll see what happens with Rocket Lab going forward. But I did take profits in two things. One, I did take profits in iron after, well, the chat basically told me that the position is already quite big. And this is basically what I wrote here. With iron up 200% for me and becoming one of my largest positions in no time, I decided, thanks to chat, to sell half and let the rest ride. Younger me would have been greedy. I think younger me, not that young, me back in 2022, 2021, I would have been greedy. So I had 1,000 shares. And so yes, it became an insanely big position for me in no time. Yes, I did add more recently, but then again, stock kept on going up over 30% in a matter of a couple of days. But overall, that position was up 200%. I still have 500 shares. What happened with the proceeds? It's in the cash pile. That's not all. After, again, conversation during the live streams, I did sell out of my Intel call options. Here again, the cash will be used eventually to buy Intel shares and increase the cash pile. My call options were up over 520%. Luckily for me, this all happened and occurred before the stocks went down. Literally, okay, it went down a tiny bit, but not the big hit that we've seen towards the later hours of Friday. So yes, I did increase the cash position in the other portfolio by quite a lot in the options portfolio. And yes, as the thumbnail says, I got lucky with the timing. I got lucky with the timing of buying these Intel shares, and I got lucky in the timing when I actually took profits and sold the Intel call options. Yes, I got lucky. But then again, maybe I make my own luck. I don't know. With iron, again, I like the story very much, actually. As you know, I covered it quite a lot. I have exposure through this story also through Nebius and through CoreWeave. But with iron literally growing into such a huge position in no time, I mean, some of you told me this in the chat. After the live, I was like, actually, makes quite a lot of sense. And again, it's just me not being too greedy. I could have said very well, actually, I don't care. I don't care. I'm up 200%. I can be up 1,000% over the next couple of years. Who cares? But when we're talking here again about quite a lot of money, especially for one position like this, I'm up already significantly year to date. Again, this is me just not being greedy. I didn't close out of the position. I just took profits. Then, as for the rest, CoreWeave still have the same amount of share. CoreWeave, I'm not touching. Again, like I said during the live stream, is suddenly we are at $200 per share or so. I will probably take some profits. With regards to BMNR, basically made a video a couple of days ago. This is what I have, 169 shares here. Whatever happens with that, we'll see. Iron, this is basically it. Now, of course, after the Friday crash, well, I'm up 165%. My average is still very low, $22.5. If we will get more news about iron, if they do announce a huge deal or whatnot, yes, I will continue then to accumulate more shares. But right now, I do still think that this is quite enough of an exposure going forward. As for the call options, the end phase one are still down, right? They're still down. They've been down for a long time. The Pagaya one are new ones, right? This is also a post I made. The Pagaya ones are also new ones. It's smaller, but these ones also already down because of Friday. They were green on Thursday and Friday morning, but as you can see, it was down 34% just on Friday. This is me basically being very transparent and telling you, this is the risk with options. For those that want to try it because, oh, you can make an insane amount of gains. Yes, but you can also lose an insane amount of money in just one day, right? Like I said, and like I show you here, my PayPal options in one day, almost all of them are down around 30% in just one day. Yes, it's true that a lot of them are still up triple digits, right? These ones are still up 145%. These ones 83%. The June ones 129%. Yes, they were up 200% at one point. And the January 2027 ones are up 95%. So yes, it's true that you can make a lot of money. Again, it really depends on the strike price that you choose, the company that you choose, and the time, right? Because you are restricted by time with options. With shares, doesn't matter. You can go to your grave with the shares. They won't expire unless the company expires, of course. But this is basically what happens with call options when we have a very bad day in the stock market. PayPal went down, what was it, 6-7%? Your options are down 30-35%, just so you're aware. Of course, when the stock is up 6-7%, you might be up quite significantly as well. It is true, but you have to understand the risks. That said, what am I going to do with this amount of money on the side right now, right? All the proceeds from Intel, all the proceeds from Iron. What am I going to do with that? Well, it honestly depends on what happens over the next couple of days, right? Because I still think that some companies, and in this portfolio specifically, right, I still want to own more Oscar, still want to own more Rubrik, still want to own more Shift4, might still see some value, some other names here. I mean, SoFi, I wouldn't mind now either, because remember, SoFi, rare earths, tariffs, and all of that, that doesn't really matter for SoFi that much. And yes, even after all my speech that I just gave right now about options, I would not mind increasing my PayPal ones, but probably January 2027. So again, leaps in this case. And the ones that I have right now are $120. I would probably maybe look at some $90 or so. Yes, more expensive, but I still think that they will be performing quite well until January 2027, bar extreme trade wars and market crashes, recessions, and all of that, of course. But all in all, that's basically what has happened during the week. I bought some shares, and on Friday I did sell and cash in quite a lot. Now, someone asked me about, oh, Duolingo, you said that once you break even, you will be selling. Well, I'm not break even yet, although at one point throughout the week, it was break even, it was up 1% or so. And yes, I still plan to do the same thing with Duolingo, reduce the exposure a little bit because, well, it is a position where I did jump into it a bit too fast, right? I have 43 shares, but I do have close to $15,000 in that position. I don't think I need $15,000 in that position, especially not when I want to still increase Oscar, Rubrik, and Shift4. And the reasoning behind all of this is very simple, and I'll play the Peter Lynch clip yet again.
I don't believe in diversification at all. I would own one stock if I could find one great stock. Diversification is a big mistake. I call it diversification. You buy this thing that might balance this other thing, and they both go down. My God, I got enough questions. I got enough questions to come at your 5th annual conference here. My God, I think we have enough conference. Thank you very much. Oh, that's a pretty good one. So I don't believe in diversification at all. I would own one stock. But what I do believe in is if I find 10 good stories, they're all equally attractive, I buy all 10. And I wait to see them unfold. It's like watching 10 poker games. 10 games of stud poker. You watch the cards turn over, story 3 gets better, story 6 slips, story 7 stays the same, but it goes up 50%. So you sell 7 and buy 2. That's all I do. So if they're equally attractive, I buy all 10. Then gradually some story says, oh my God, this is getting better and better, and guess what? The stock just went down. So you keep watching 10 stories, and magically, because of that rule of stocks going up and down a lot, then you load up. You really, take a big advantage. So that either happens because something happens to the company, or the market goes down. And
to me, it's very simple, and you know it. You've told me this in the chat. You've told me this in the comment section as well, right? We're not married to any stock. And so, yes, here we have 20 stories, although it's not really 20 stories because the Palantir, the NVIDIA ones, is just literally 4 shares. Doesn't matter here. But I have here, yes, a couple of stories. And again, the top positions do make up the majority, or at least almost half of the portfolio. But yes, I do have a lot of stories. And over time, some stories will become more interesting than the other. And so some names can be cut in this portfolio in order for me to take advantage of maybe bigger dips in, let's say, Oscar dips 20%, right? And Duolingo suddenly goes up 20%. Yes, the chances are quite high that I'll cut Duolingo to increase Oscar because I like this story more than the other. Same thing can happen with any other stock right here. One story can suddenly become way more interesting than the other. One opportunity can also become more interesting than the other. Of course, when you have a large amount of cash, you're less inclined to start cutting good companies in the portfolio. You're more inclined to use that cash and increase your positions. Now, going back to what has happened on Friday and what might happen in the next couple of days. So, of course, we've had this whole China situation, a rare earth situation, and then Donald Trump's tweet, 100% tariffs, 150%, 200%. Every second the percent has changed. Okay, I will meet him. I will not meet Xi because they were supposed to meet in South Korea at that summit, I think 2 weeks from today. Then it was either, oh, we were supposed to meet, but now what's the point of the meeting? And then it's, oh, I might still meet him. So we'll see. I mean, we've seen it play out before. And actually, we have someone else that said the same thing. This is Adam Kobasi from the Kobasi Letter, very, very good and informative page on X. And he said the following thing.
Front now, Adam Kobasi, financial. Out front now, Adam Kobasi, financial analyst and founder and editor-in-chief of the Kobasi Letter, and of course, Dan Ives. It's great to see both of you again. Adam, just the context here, though, because you've been following a lot about this, that the market's been going up and up and up, and maybe going up in the face of some pretty scary economic stuff to come. Nobody knows, but it's been going up, and it's been going up because retail investors, right? Not big, sophisticated investors. Retail investors have been buying. So a lot of people have just bought in the past few weeks, right? Those people just got crushed today.
First of all, what are these subtle insults to retail investors suddenly? Didn't like that comment. Second of all, if you bought a couple of weeks ago, actually, no, you are not crushed today. Not at all. You might actually still be up today. If not, worst case scenario, you are break even.
That's pretty scary. So what do? I mean, do you think Trump follows through with this and this plunge actually lasts or not?
Yeah, I mean, look, retail inflows have been very strong, as you suggested. But I think this is really the textbook Trump playbook that we saw back in April, where he starts with these very big threats, these things that kind of cause these sharp reactions. And then he slowly starts to use it as a bargaining chip to reach a deal in what he's looking for, or what he views is a sustainable trade deal. And I think we already saw the first hints of that literally an hour ago. After the market had closed, President Trump said he actually hasn't canceled his meeting with China's President Xi yet. So I think this was the first sign of that. I think this weekend we see more happening. And ultimately, I think this dip is going to be bought. I think that the factors that have been driving the market higher for the last few months are incredibly strong. I think earnings growth is strong. AI is strong. The Fed is cutting rates. And we have deregulation in the background. And simultaneously, the market was up almost 40% in 6 months. I think we really just needed a reason to sell off. Today kind of caught everybody off guard, and the market fell sharply. But I don't think this is something that's going to derail us and send us back to the lows. If anything, we're looking to kind of capitalize on this and buy the dip.
And I agree. I think the market has been looking for excuses, reasons to take a breather, to crash. Right? It's been weeks and weeks, actually months, that the market just keeps on going up and up and up. And everything that we're hearing is, oh, this is 1999, this is the dot-com bubble, the bubble is about to burst, etc. Every single week, everyone's going on TV thinking they're smart. They're like, oh, this is the data that really resembles what happened 25, 26 years ago. We might be in October of 1999, so that means we can still go up, but then after we go up, we might be going down. Right? Congratulations, really Nostradamus stuff going on there. Anyways, I do think here the same thing will happen. Also, this again happened on Friday, which gives whoever needs time to talk about stuff, well, time, because it is the weekend. Markets open up again on Monday. Columbus Day, I do believe, bond market will be closed. Also, CPI report, since there is a government shutdown in the United States, will not be released until, I think, October 24th. Even if the government is still shut down, just so we know. Then let me talk here about a couple of great charts from the book Just Keep Buying. This here shows us the buy the dip strategy versus dollar cost average all the way since 1970. What you can see here is, of course, the darker line is the buy the dip strategy and the light gray line is the dollar cost average strategy. What you can see is that the dollar cost average strategy has beaten the buy the dip strategy over that long period of time. Yes, there are some times that if you manage to really only buy the dip, the bottom, it made more sense than dollar cost average. Then again, they also show you a couple of other scenarios. For example, here in 2008, near the top, here dollar cost average makes less sense. Why is that? Because by the dip, the rules here, by the dip, will only be buying near the bottom, if not at the bottom. The dollar cost average strategy will make you buy all the way to the bottom. Okay, but again, if we look at the big picture here, what you see is that no, you shouldn't be waiting for dips. Moving on and looking at the averaging in versus buy now strategy over a 12-month S&P 500 return, you can see that again, over a long period of time here, what's here at the top, that's average in that outperforms buy now. But if you look at the bottom, which way more time that has happened, average in underperforms buy now. So again, I know these things are maybe in your head counterintuitive, and I know emotionally sometimes it doesn't make sense, but this is the data. We're looking here at something else. Average in versus buy now over 12-month period for US stocks as a whole. You look here at the top, average in outperforms buy now, and then at the bottom here, average in underperforms buy now, and you can clearly see a difference, a lot more time and bigger underperformance. And I wanted to show you this one because, well, it is a good book. I'm not sponsored, but it is a good book, good lessons. And two, especially now, right? We've had an insane year, or insane already 3 years. It's funny because Friday was that 3-year anniversary of that bull market. Well, one heck of an anniversary, right? But we've had an amazing year, right? The performance year to date, me personally, incredible. I've just shown you I was lucky with my Intel call options. They've been working quite well. And now, yes, I am sitting in a lot of cash. And so on the one side, I'm like, actually, maybe we should wait and see what happens with this whole tariff story. Yeah, I'm not saying that I'll have to put every single dollar at work right now, but I will continue to buy. I will continue to buy because I'm still seeing great companies at good prices. And so again, with my questions from Friday, did you change your mind about what you own? Right? If you can answer that question, then I think your investing journey will be much easier going forward, especially during volatile times. Do you have cash on the side? Have you been taking profits over the last couple of weeks? Have you been taking profits of stocks that have really gone up a significant amount, right? All of these Bitcoin mining stocks, for example, all of these quantum computing stocks have gone up significantly over the last couple of months. Have you taken profits? Or, let's be honest, have we been greedy? Easy question to answer. Then, did you say, if you have cash in this case, did you say previously, if it drops, I'll buy more? And if you did you buy more when it dropped? Or did you say this sentence again when it dropped? Again, ways to understand how you behave during volatile markets and during your investing journey. Bottom line here, as I said on Friday, is do not panic. Okay, we've seen these events before. We're going to see these volatility events again in the future. It's important to not panic. Have a plan. Now you might say, yeah, but you didn't even have a plan. You didn't want to sell your Intel call options or your Iron shares. Well, first of all, I was thinking about selling my Intel call option, which is why I asked that question to the options experts, because I admitted I'm not an options expert. I recently started with it. Okay, that's why I say I got lucky. But yeah, the plan was to either take profits or sell it all. The answer was sell it all. Then with Iron, yes, that was more of a impulse, let's say, profit-taking one. Okay, no problem admitting that. But looking back at it, I think it was the right thing to do. Again, it's me trying not to be greedy, because greedy me got completely screwed just a couple of years ago. Right? Everything went well, 2020, 2021, and then suddenly 2022, it didn't go well. Why didn't it go well for me? Because I was greedy. I didn't take enough profits along the way. Not doing it again, pure and simple. And so overall, that's about it for me right now. I did some buying, did some selling, and next week I'll probably do some more buying as well. I might increase the cash position in this portfolio from the proceeds. Let's see, because options is again in another account, so we'll see, but I will update you here in the community tab or the live streams. So all in all, that's about it. Let me know down in the comment section below what you're about to do next week. Any specific things that you're looking to buy, let me know down in the comment section below or sell. We'll see each other in the next one. Bye-bye.